Corporate Finance Presentation, Merger and Acquisition Overview. Get ready, it's time to take our chance with corporate finance. Business combinations. Business combinations are generally either acquisitions or consolidations. When we're thinking about an acquisition, we're thinking about a combination of two or more companies. The company will generally keep the identity of the acquiring company. So in other words, an acquisition is what you would think it would be if you're talking about two companies. They're typically being a dominant company. At the end of the day, you end up with two companies, but the dominant company, in essence, being in control. You're keeping the name of the dominant company, and typically the management of the dominant company is going to have control over the utilizations of the assets after the merger is taking place, therefore the term acquisition. Now, note when you get into kind of the weeds on how you can set up or format what the acquisition process or merger process would look like, that gets into some crossover between kind of financing, decision-making processes, and basically accounting. So if you want to get more into the details in terms of how the acquisition could take step-by-step forward, we have an advanced financial accounting course that goes into in a lot more depth in those type of decision-making processes, getting kind of more into the weeds on it. Then we have a consolidation. There are two or more companies combined to make a new entity, used when the companies have similar size and market power. So if you're looking at two companies that are basically similar size and market power that are merging together, and note that's a little bit more unusual because oftentimes you're thinking about a situation where one company is basically a dominant company that in essence, when you're merging together, one will have kind of control. It's going to be a little bit more difficult oftentimes to negotiate a deal between two CEOs and whatnot of equal size companies that are willing to kind of give up power and whatnot in order to consolidate together. But if you have a situation where that does happen, then you would think about more of a consolidation type of process where that you'd have, a joint control over the company as opposed to an acquisition type of situation where the owners of the dominant company basically have control over the entity after the process has taken place. Now, of course, the structure on how these would take place, again, from a logistical standpoint, how you would set it up from a step-by-step process kind of crosses into financial accounting. And if you want to look more in terms of the financial accounting side of it, take a look at the Advanced Financial Accounting course where we spend more time diving into the components on how these things can be pieced out or structured. But the general idea are these. Now, there's also the term of a merger, and here's where things get a little bit confusing because the terms are not always consistent. So in other words, you might see this consolidation replaced with a merger. In other words, contrasting the acquisition to the merger, the acquisition clearly being where one company is in essence consuming the other company, whereas when you're thinking of a merger, it could be used contrastively to indicate two companies of similar size that are merging together instead of having an acquisition situation. The problem with both these terms, in terms of the consolidation and the merger type of term, is that from a technical standpoint, from just an accounting standpoint, you can think of them as basically being kind of the overarching term for, in essence, two entities or more that are going to be consolidated or merged together for one entity. And if you look at it from that standpoint, then you can use that term merger or consolidation as the overarching term, and then think about what kind of merger or consolidation is it? Is it one in which it's, in essence, an acquisition? Whereas if you look at the end result of an acquisition, one company, in essence, has control, and the management of one company, in essence, are in control? Or is it a situation which would be a kind of an equal kind of situation where the two companies would be coming together and having somewhat shared control within the new entity, possibly having a new company name or something like that, or possibly creating a new entity? Again, the logistics of how it would be set up if you have an outcome where the two entities are equal and you're going to have kind of an equal setup at the end would be different logistically, and you can go into the financial accounting course to get into more details on that. But just know from a name standpoint, it can be confusing in that way. Also note that even if something is clearly structured as an acquisition, meaning at the end of this process, one company is basically going to, in essence, be in control, they will often use the term merger still because the company being acquired doesn't like the term acquisition, most likely, and therefore they're going to be able to say, well, it's a merger. You're going to use the term of a merger both because it's kind of the overarching term where we're basically merging two entities together, two financial statements together, and also because clearly when you're advertising the merger process for the acquiring company, it's nicer for them to be able to say we're merging as if it's a consensual kind of merger thing. The other way you can distinguish these things is you might call it a merger or a consolidation, and then within the distinction down here, you might be saying, okay, well, is it a hostile kind of merger where basically the company being acquired is not wanting to be acquired, or is it a friendly type of merger where the combination is something that both sides are wanting to do? That's another kind of way that you can break out these terms or think about the structure of what kind of merger we're talking about. Reasons for a combination, financial reasons. So in other words, why would two entities want to go through the process of a merger considering it is a time-consuming and costly process? One, the acquiring company may be able to reduce risk while maintaining its rate of return. So if you're thinking about a situation, which is often the case where one company is kind of a dominant company within the merger process, thinking of it as, in essence, an acquisition situation, it can be similar in some respects to a capital budgeting type of decision, the acquisition resulting in future cash flows that you would have to be analyzing in a similar fashion. It could result in a situation where, although you have the same rate of return, we could be reducing risk. So in other words, if you were to think about the earnings per share, for example, you might have the same earnings per share, but if you can reduce risk, then it would still be a beneficial thing. How would that happen? Well, if you're merging with a company that's basically in a different industry than you, or they'll benefit from different structures, or they're going to benefit from different swings in the business cycle, then you're going to, when your company is not doing as well, or if it's low in the business cycle, the other company might do well in that area, and they can offset each other in a similar way as a diversified type of portfolio. So even if you were able then in that situation to get the same rate of return, you might be able to reduce risk, which might be able to provide value to the stockholders, resulting in the market price going up as the stock market sees less risk and values it higher. So it can reduce performance of variability for companies that have opposite phases of the business cycle. So that's a similar kind of thing. If they can lower the risk if you're merging with another company that has opposite side of the business cycle, that means when you're doing well in the business cycle, the other company might not be doing as well, but when you're down on your business cycle, they're going to be up on their business cycle, and that can, again, hedge out the risk that would be involved. So the larger company could have more access to capital markets. So if the company's larger, then you might have more access to capital markets in order to fund the company and expansion in the future. Could attract larger investment bankers to help with future financing. So you could have, more access to finance, professionals that are going to be top tier professionals to help you out with the financing. The acquired company could have strong cash flow and low debt to equity ratio that could help in expanding borrowing by the acquiring company. So if you're acquiring a company and you're saying that company has a lot of cash flow, then that could be something that you're looking for, of course, so that you can basically, if you're in an expansion mode, you might want to acquire a company that has that cash flow so you can increase basically your ability to grow by spending the cash flow and investing it and possibly giving you access to more borrowing power if you're in an expansion mode, and the borrowing would, of course, be beneficial in that case. We have the tax loss carryover. If one company has a tax loss, it could result in a tax benefit and be an incentive for the merger. So in other words, if you think about taxes, oftentimes you have a situation where the losses, if you have a loss, then the government doesn't pay you for a loss, right? If you have income, that means the government will basically say, we want part of our income. We want some of your income as your silent partner. But if you have a loss, the government will usually restrict the amount of losses that you will have. Now, tax laws can change over time, but generally they're going to say it's an income tax. You have no income. Not only do you have and so there's no income, so we're not going to tax you. And as the company, we come back and say, yeah, but I have a loss and you're my partner. You should be eating some of that loss, right? And the government's like, no, we're not going to be eating the loss. We only collect taxes. We don't pay you for losing money, right? And then, but we'll give you a benefit for it, since we are kind of your silent partner, in that maybe you can carry that loss over into the future, net it out against income. So we're not going to pay you for losses, but you can use those losses to net out against future income possibly. That's generally how it will work. So if you have a consolidation system then, where a company has losses, that they haven't been able to utilize for taxes, possibly through the merger process due to the company that is merging with them having income. You can get access to those losses, which can have a tax benefit and a positive cash flow thing. So that could be a beneficial situation if you can have positive tax benefits. Again, taxes have a big influence on a lot of these big decision-making processes in funny ways, and that's one of them that could be there. So reasons for a combination: non-financial. They may wish to expand management, marketing capabilities, and acquisition of new products. So it might just be basically, two companies are merging together, possibly just thinking that we have the best management. If I expand and just be larger, our management can add value to this other company just because they're good, and they can increase in that way, increase value. Market capabilities, it could give them a better edge in the market, and so on. Just could be a better positioning type of situation as opposed to strictly being a financial type of situation. Could have vertical or horizontal integration. So two companies might merge together on a vertical or horizontal type of situation. So you might be merging, for example, with another company that is in your industry. And in that case, that often happens when there's not a whole lot of people in the industry, maybe, and you're trying to really capitalize on the market share within the industry to be a bigger piece of it and capitalize on the expansion of basically larger companies, economies of scale, for example. And then vertical, you might be merging with companies that basically are in the production cycle, in the supply chain, in essence. So if you're McDonald's, you basically invest in farms and whatnot that might help you within the vertical integration chain. So they must be careful of antitrust policy designed to stop, eliminate of competition. So antitrust policy typically being designed to stop companies from doing things that, there's the whole, you can go to antitrust law and what it means forever. But generally, it's either to stop companies from doing practices that they think are anti-competitive, meaning they're doing things that are wrong, that they're not competing properly within the market. They're cheating in some way by abusing or threatening, in some ways, pressuring in ways that we shouldn't be proper. Or some people just view it as too big. You're just too big. The company's too big. And just by virtue of being too big, even if you didn't do anything wrong, we want to cut you down to have competition. So the idea of the antitrust, no matter how you look at it, is typically to increase the competition, to stop the monopolization, because if you have monopolization, then you have no more competition, and the downside, of course, is the consumers lose out given that. So we have synergistic effect that may reduce overlapping function and combine steps of engineering capabilities. So in other words, you might have two companies that get together, and the one company has good cash flow or whatnot, but we can synergistically put these two combinations together in such a way that it would facilitate the existing company better. They can do what they do better and increase their own profits through that combination. And that would be obviously a really good thing if you had a combination that just clicks together well and increases the operation of the acquiring company as well. So the horizontal merger, as we looked at a little bit, the companies operating in the same industry, generally between two or more competitors offering the same product or service. Common in industries that have fewer companies, the goal being to capture greater market share in economies of scale. So oftentimes when you have these economies that actually do better, when you say economy of scale, you're talking about the warehouse stores and whatnot, which actually they're in industries that benefit typically by being larger because they're in economies of scale. So largeness is good in those types of industries, and therefore there's an incentive, of course, to mergers to be big. That's not necessarily the case in all industries, but when you're in a situation like that, that will incentivize mergers. We have vertical merger, two companies operating at different levels within the same industry, the same supply chain, combined operations. It can increase synergies through the cost reduction. So that's the one where you're basically merging with people that are in your same supply chain on a vertical type of situation that can basically reduce costs, you having more control, direct control over the orders of production within the whole supply chain. So stockholder motives. So you might say, well, okay, what about the stockholders here? They're the owners. When you look at these, when you think about mergers, you often think about these two behemoth organizations that are like their own animals that are basically merging together and one's consuming the other. But really, of course, the owners are the stockholders here. What's the motivation for the stockholders? So if cash is offered, you might have a situation within the merger. There could be a tender offer or something like that, and they could be offering the stockholders cash. So and again, this gets into the structure of the merger. How would you actually structure the merger to do what you want to do, whether it be an acquisition, which is often the case, or kind of a consolidation type of situation? Well, one way to do that is to basically go to the shareholders and try to offer them, give them a tender offer or something like that, so that you can acquire an acquiring interest of the company, which would be over 51%. And then at that point in time, you'd have a controlling interest, and then you might try to squeeze out the rest to get, a full 100% or something like that once you have a controlling kind of interest situation. So the stockholders then, of course, are going to benefit in that situation by getting cash. And if they get cash, that's why they're going to sell the stock, and they can use that to diversify their portfolio in some other way. So the offers could receive attractive post-merger management contracts. So if you're talking about the officers then who are owners of the company, then they're going to have influence in many ways. So they might basically benefit from having attractive offers in the post-merger situation with regards to their management in the post-merger.